As long as capital is stewarded in a way that's conscientious across all parties and everyone's satisfied and agreeing to the terms and nobody's being taken advantage of, that's where finance can be additive and regenerative.
Welcome. Today's guest is Brandon Welch. He is the co-founder and CEO of Mad Capital. Mad Capital provides financing to regenerative ranchers and organic farmers. We met Brandon because we're actually investors in his fund, which we'll talk about. And what gets me excited about this conversation is I think what Mad Capital represents is a really practical and scalable example of regenerative finance. And the promise is that we can move billions and billions of dollars into regenerative and organic farming and agriculture. Thank you, Brandon, for being on the show with me.
Thanks for having me. It's excited to be here.
And so starting from the top, how would you frame Mad Capital and what you're doing?
We are a lender to organic farmers and to regenerative ranchers. So we're pretty simple business. We raise capital from family offices, high net worth individuals, foundations, advisors, and then we work to find farmers and ranchers that are thinking about a transition on their farm. So typically that's one of two different transitions. They're either a row crop farmer in the Midwest that is moving land from conventional to certified organic while using regenerative practices, or they're a rancher that's moving from continuous grazing. So this is basically like set stock grazing where you just let the cows out to pasture, they graze on whatever they want. Moving from that to a type of ranching that really emulates how the bison used to move across the American prairie. It takes time, resources, financial capital to make that transition. And that's where Mad Capital can step in and help farmers through the J curve, is what we call it, because there's really a chasm where to go from that year zero to really a thriving organic farm or regenerative ranch. It can take 3 to 5 years, depending on the transition, before they can really cross into a very profitable business and one that's more profitable than before the transition. And there aren't that many partners that are out there that are really willing to saddle up and partner with the producer through that challenging time, because it's rare, and there aren't that many farmers that are thinking about that transition relative to agriculture as a whole. You know, in the U.S., only 1% of all farmland is certified organic, and we estimate that about 2 to 3% of rangeland, and pasture land that ranchers are stewarding, is holistically managed. So we're talking about anywhere from 1 in 100 to 1 in 25 producers that are actually operating in the way that aligns with our values and the type of food system that we want to create.
And why is it ultimately profitable or more profitable to move to these types of models?
So depending on the market segment, there's a couple levers. So if we want to break down the profitability of a farmer or ranch, there's kind of a simple formula. You look at yield times market price minus expenses. So those are kind of your 3 levers. So in an organic farm, they actually produce slightly less yield, about 18% less yield, but they can fetch a higher market price. If you look at big commodity, large grains like corn and soybeans, those tend to sell at about twice the value over conventional. So today, conventional corn is about $3.50 to $3.75, whereas organic corn is close to $7.50 to even $8 a bushel. And that's a spread that's compressed and expanded over time. Depends on different macro and market conditions and demand for organic, but it tends to sit at around 2x. And then expenses for organic are roughly the same. They can be more if the farmer isn't located near a good fertility source, because using natural compost and manure is critical, since you can't use synthetic nitrogen. And if they have to ship that compost, 100, 200 miles, that's where trucking costs can really eat into their margin. So if you just look at that formula, say 20% less yield, but twice the market price, similar expenses, we're talking about increasing their margin by roughly 80% or so. But it does depend farm by farm. Sometimes organic farmers can secure a contract that's paying 3x over conventional. Other times, and depending on their region, they might not even be able to have access to an organic market because they might have to truck it 300-400 miles, and that cost would eat into the entirety of their market gain. So that's where the profitability comes on the row crop organic side. On the ranching side, there's demand for grass-fed beef. People want a healthier, nutrient-dense product, and there's now data showing that grass-fed beef tends to have a better omega-3 to 6 ratio, which is better for people's cholesterol by lowering their saturated fat levels. So they're willing to pay a premium for grass-fed beef. That ranges anywhere from a 50 to 100% premium, and it depends on the cut. Like a fillet has a bigger spread than ground beef, for example. But from a yield perspective, so basically the number of cows that a rancher can put per acre can actually increase by using holistic management. So you can increase the forage production and ultimately the amount of grass that the rancher is producing. Because at the end of the day, they're grass farmers. That's what they're growing. So if they can increase the amount of sunlight that the grasses can collect, increase net primary production, produce more calories on the land, that's going to result in more calories on the cow. So they can increase both yield and access to their market, and expenses are roughly the same as well, to potentially slightly higher depending on their management if they need more labor to move the animals around more consistently. So those are the profit levers, but both of those systems, or transition to organic takes 3 years, transition to holistic management, technically it's a type of management, so it can start the next day, but to actually see the grassland through its full transition phase to full productivity depends on where it's starting. Is it a desert that's been totally extracted and essentially just mowed over for decades, like we see on a lot of BLM or national forest land? Or maybe it was actually a well-managed operation, and now the operator's just trying to take it kind of an incremental step forward.
Right.
So those timeframes can range from 3 years to, multi-decadal to see a full regenerative cycle.
Right. So there's motivation to achieve these types of models of regenerative and organic farming from a financial perspective, and obviously there's this challenge of getting through the J curve, which we'll talk more about. But can you also speak to what are the other motivations of farmers that you're working with besides just the financial, aspects? Yeah,
there's actually a study that came out a few years ago trying to get to the basis of why farmers are making a transition to organic. And oftentimes it's because of a close relative going through a family health crisis, whether it's they suddenly found out they have cancer, or maybe heart disease, or something that's mortal and imminent, and they either passed away or they had a close call. A lot of the farmers that we work with have had some experience that's similar to that, and their mind immediately goes to the fact that they were spraying herbicide in their field. They don't let their kids play in that field after they spray herbicide, yet they're exposing themselves to it on a daily basis.
Right.
And suddenly there's just a moment where it clicks. They realize that these two things are probably related to some degree, the amount of chemical exposure they're having and the health outcomes that they're seeing. And that's where oftentimes many of these producers decide to make a shift, make a change. I'm sure there are other reasons. There's also major cultural barriers in agriculture as a whole. Think about if you're a corn and soybean farmer in the middle of Iowa, your neighbors and their neighbors and everyone for as far as you can see, they grow the same two crops and they grow them in the same exact way, same methods, same timing. They sell to the same buyers. The moment that someone kind of steps out of line and does something different, you immediately draw attention. You draw eyeballs. And unless someone has that kind of innate rebellious soul, they're not going to feel comfortable being, the weirdo on the block that's cover cropping in November or planting sunflowers in a field of corn and soybeans. It's very obvious when someone is doing something different.
Totally.
And then they feel like an outcast. So it takes a certain type of person to be willing to take that risk.
Yeah. Yeah. I would add, definitely that matches our experience that the peer-to-peer referencing amongst farmers can't be overstated. And, but also the consulting, quote unquote experts who come in that are still representing often the interests of the fertilizer companies and kind of the old conventional models have a really strong influence depending on the area. That's another barrier we've seen. And then, it's this interesting catalyst moment can also be as the farm is passing down to the next generation and seeing kind of these younger generation farmers more interested in regen and organics. I'm not sure if that tracks to what you're seeing.
It definitely tracks. Yeah, I'd say I don't have an exact number, but our portfolio tends to be younger than the average farmer. I think the average farmer in the U.S. is 59. I would say our average farmer is in their mid to late 40s. So it's our whole decade younger. And there's often a tension where that farmer in their 40s, their parents are still around, and the matriarch or patriarch have certain ideals of how the farm should be managed. And in that succession, the younger generation is often fighting for what they know the future of the operation is going to be inevitably anyhow. But it's often the patriarch of the family just doesn't want to give it up. So they'll keep farming the way that, their father did, their great granddad did until they pass away. And then eventually the farm's ready for a full transition.
It's tough. I mean, it's tough to farm land in a specific way for a generation, 2 generations, and then, to see it potentially just things really radically shift. And that's a difficult pill to swallow, especially if it feels unproven.
It's scary.
Yeah, go ahead.
Well, I could imagine a scary endeavor. You only get, they say you have about 40 seasons of farming, right? So you have 40 shots a year if you're an annual row crop production. And to try something new is a large experiment on the operation, especially if you'll do it on the entire farming base. So to not have absolute confidence in taking a practice means not having absolute confidence that they're going to have the cash flow to put food on the table next year. So part of our work as well is being able to prove that regenerative organic farming is lower risk than the alternative industrial way of growing food. Right. And we think that that's true. The data in at least the early stage is showing that that's true. But we're small. We're working with about 40 producers right now, 160,000 acres. We're starting to scale, but it's going to take, many hundreds of farmers over millions of acres to have a more definitive data set.
Yeah. And the regenerative grazing part is maybe a bit newer on the scene in terms of how we currently are framing it and discussing it. But organics has been around for decades as it's currently known. And yet we're still stuck at this 1% level. Given the premium that organic products get at the supermarket, you would think that the market would kind of have sorted this out by now and that we would have more scale. And so obviously that's what you're directly addressing. But I'm curious, why is it that J curve, that initial expenditure, has been so difficult to get through for a lot of farms?
The J curve is challenging for many farms because they have to operate the farm organically for 3 years without getting paid organic prices. So the moment they decide to transition at year 0, they now can't use a GMO seed. They can't use any prohibited synthetic products. It has to be OMRI approved, which essentially means it's organic approved. So as long as it's organic approved, they can use it. So they're taking a yield hit, selling into conventional markets, and many conventional farmers they're only making net margins of 2 to 3 to 4%. These are small margin businesses. So the moment you take away 20% of your yield, going from 200 bushel to call it 160 bushel corn, their profit margin just got eviscerated. And now they're below break even anywhere from kind of that 15 to 20% range. So that creates a challenging situation where over 3 seasons, if they're in the whole 20%, they're down 60%, if you're looking at it on a total cumulative 3-year basis. Mm-hmm. Most lenders that we interact with and that farmers across the U.S. interact with aren't comfortable with that transition because they don't have the confidence that the organic market's going to be there, because oftentimes, because organic farms are so rare, these community lenders haven't interacted with an organic farmer before. So they don't want to take something that's a little odd all the way up to their credit committee and their board of directors and get it approved. So it's just easier for them to say no to this one farmer wanting to change because they've got literally 99 other farmers right behind that guy that just want a traditional operating note to grow some corn and soybeans. So there is a cultural barrier there and just lack of comfort that we're now helping break down. And I think as we see the numbers increase and we see 2, 3, 4, 5% of U.S. farmers reaching certified organic, that's where it's going to be more normal. And groups like Farm Credit and Rabobank and these large ag lenders, they're going to be forced to change or adapt because we'll be taking away market share from them. And if they're driven by profits and being able to offer comprehensive, services to farmers and ranchers, they're going to have to start thinking about it. So that's part of our role as well, is making them feel the pressure so that they also start launching their own products and they're able to support these farmers too, because we can't do it alone. I mean, there's $4.5 trillion of ag assets in the U.S. and roughly $500 to $600 billion in debt. It's an enormous marketplace, and Mad Capital isn't going to do it alone. So that's why it's exciting to be here at Climate Week and talk with all the other partners that are also helping finance the space.
So I want to talk more about the fund, but first, could you tell me a bit more about your journey, how you got into this line of work, and what's been the motivations?
Yeah, I appreciate you letting me warm up a little on the stuff I knew before talking about myself. My personal journey. Where do I want to start there? Well, I was born in. I'm kidding. So I grew up south of Boston, a little town called West Bridgewater. And my family had a cabin up in North Conway, New Hampshire. So I spent a lot of my childhood just kind of rummaging around in the woods with my 2 brothers, fly fishing, hiking, snowboarding. That's kind of where I really cut my teeth in the outdoors and just fell in love with nature. So when I graduated high school, I ended up going to school in Vermont, studied mechanical engineering and environmental science. Ended up going on a couple of adventures while I was there. I hiked the Long Trail through the state of Vermont my sophomore year. And then when I graduated, I biked across the country from Boston to Pacific City, Oregon. And I didn't know it at the time, but I had spent 2 months essentially just surrounded by corn and soybeans. Was thinking about how odd it was being in a sea of monoculture agriculture, but I hadn't thought about the food system at that point. I was 22, and I was my head was around somehow getting involved in the climate space as a whole. But I had a lot to explore, and I was open-minded as to where I would land. After I went on that adventure, I ended up moving back to Vermont for a year, worked in a lab doing water quality testing. It was a horrendous job. I was getting paid nothing. It's like $14 an hour, plug and chug these little water samples, testing Superfund sites all across the United States. And I actually listened to the Tim Ferriss podcast often while I was there, just in the lab in my lab coat with, blue gloves on and a hat and glasses. And I'm just testing these water vials and I'm, listening to all these inspirational folks that have done amazing things in the world. And I decided while I was there that I wasn't just going to settle for working in a lab. I didn't feel empowered. I didn't feel excited by life. And the next summer, my wife and I ended up packing up the truck, and we went on a 4-month road trip, went through the whole western half of the U.S., visited a lot of national parks and different cities and towns that we had in mind that we wanted to move to. And we had decided that we wanted to move west and just kind of start fresh and figure out where we wanted to root down. So we landed in Boulder, was able to get an internship that I then turned into a job managing a small nonprofit that was doing work developing carbon offset projects in Colorado. So we were developing avoided grassland conversion projects and then methane capture projects. And really early on in that process, I think it was December of 2017, I got an email from Phil, my co-founder, and he wanted to help farmers and ranchers transition to carbon farming is what he was calling it back then. I thought it was interesting. I hadn't really explored this space, but I was kind of adjacent to it, being in the carbon market space. And we sat down, we got a coffee, and immediately just like hit it off and knew that there was something here with this guy. It was like he was a little kind of frenetic at that point and a little crazy and like had a bunch of ideas. It was exciting. It was exciting to be around him. So through 2018, decided to dive in to just figuring out how we could help farmers and ranchers and figuring out if actually we could incentivize them to transition their farms through developing a carbon market. So we toured dozens of farms, ended up building a relationship with Nori, which was an early kind of carbon marketplace. Talked with the folks at Regen Network. I'm sure you're familiar with some of these folks.
We've had Paul Gamble and the Regen folks on the show. Yeah.
So they were pretty influential to us because we wanted to work with them as our MRV partners. But what we learned through that discovery phase and really just taking like an empathetic approach of getting on farm, listening to their struggles, asking them questions without trying to not have any bias towards carbon markets. Just ask, well, what is hard about what you're doing? We learned that none of them are talking about, I want to sell carbon credits. That was an idea that we had cooked up in the lab. They were talking about more fundamental problems. They were saying, I don't know how to plant a cover crop. I don't know what a weed zapper is. I don't know how to go no-till. So it was advice. They couldn't access the knowledge and education that they needed. Was one pattern that emerged. The second was they were struggling to access the markets that they wanted to be able to sell into. If they were going to take the risk to transition the farm to organic, they needed to know where to sell it, or if they were going to transition to holistic management. That was a constant friction. And then the third was access to finance, because oftentimes their bank, their local lender, wasn't comfortable with them adopting these practices or making a transition. So out of that exploration in our kind of own educational journey, we ended up realizing that we needed to create a holistic system to help address some of those challenges and those constant problems that producers were having. So we launched Mad Agriculture, which is a nonprofit that helps farmers with farm and business planning. And initially, Mad Capital was actually housed under the nonprofit. So I was the first employee at the nonprofit. I was working there all the way through 2022, actually developing our financing arm. And we were also incubating Mad Markets, which is a brokerage and trading firm to help farmers access the new markets for their crops and animals. So initially, it was all housed under Mad Ag, but we realized that the 501c3 just wasn't the right container, wasn't the right scalable vehicle to be able to take this to the level that we wanted to. So in 2022, we ended up separating Mad Capital into its own public benefit corp. We raised a seed round, and that's what's allowed us to scale to where we are today. And then Mad Markets officially split out in 2023 from Mad Agriculture. So now we have a collection of entities that are all working on the same mission and vision. We have the same brand, all under Mad, and we're working together to try to impact 10 million acres of farm and ranch land by 2032. That's the goal. So we meet once a year. At the end of the year, we kind of have a convening of our strategic priorities, what we've accomplished, how we can help each other. And then we work fairly actively together on a quarterly basis, as well as we have an open Slack channel. So we're able to convene around a single operator if they really need access to all three. different value streams. But oftentimes we're working with folks who have a really particular problem where they need capital for a specific piece of equipment, or they don't know where to buy their cover crop seeds and they give Clark a call, or they want to be able to sell their lentils at a value add, and then Mad Markets can help sell that to Kava. So that's where I think in our ideal form, we'd love to show up holistically and help farmers with all three. But the reality is most producers don't need all three. They have kind of one really weak link and maybe a second constraint. But oftentimes, if they need capital markets and advice, maybe they shouldn't be farming.
Right.
Yeah.
Yeah, it's interesting to hear you talk about the carbon markets in that way, because that matches the experience I had coming to New Zealand. I helped steward a farm, Mangrove Farms, and we thought that there would be promise in matching regen ag with carbon credits.
Yep.
But the economics just are not there right now. And so obviously on the reforestation side, there's promise, but the practical economics for us trying to manage pasture land regeneratively, there was really no emissions trading scheme or carbon credit opportunity.
That's what we were seeing as well. So if we were to just run the simple math in the United States, there's roughly about 1.2 billion acres of managed land, about 400 million acres of cropland, roughly 8 to 900 million acres of pasture and rangeland. So let's just call it 1 billion. And imagine if each acre could sequester 1 metric ton of carbon, which I think is generous considering the amount of arid, rangeland that's out there. 1 metric ton, and let's say buyers are willing to pay $20 a metric ton. That's a $20 billion a year market. If you look at ag as a whole in the U.S., ag GDP is about $500 billion. So you're talking, if every acre was monitored, monetized, and sold per year at 1 metric ton at $20 per metric ton, you're talking about adding 3 to 4% in top line revenue to farms and ranches. And that is not enough of a carrot to create fundamental change at a systemic level.
Right. But it's not to say we don't still need to do it.
Oh, I think it would be a great cherry on top if we can do it. And
but not even just do it in terms of the carbon credits, but do it in terms of the farming practices need to change.
Yes.
Right.
Yes. I think in the interim, there are other bridges that we should be focused on helping the producers cross to access new markets and adopt the practices because of the resilience that their farm gains. I am hopeful that we're going to figure out cost-effective MRV and there'll be a more reliable buyer network. I struggle to see that as being the game changer that really takes the food system to the next level. I think it's part of this stack that's coming together as a whole, because it's going to take a variety of types of capital and variety of types of advice and risk management and getting producers comfortable. I'm not a believer that there's a silver bullet out there to help this food system because it's too complex.
Right. So practically, though, having a capital partner who understands the shift to regen and organics, that is not servicing 99 out of 100 of their clients, in the conventional methods, but actually has their backs, wants the same thing, maps to the same value set. It just makes perfect sense that there would be this market need. And so how's it going so far? Like, how's the momentum? How's the fundraising? What's it been like?
The momentum's going great. Remember, Phil and I were sitting around in 2019 at our co-working space. And at that point, we had established that financing was a core barrier. We decided one night, like drinking a beer in the co-working space, we decided we're going to go for it. We're going to go raise a fund. We're going to help farmers and ranchers. I have no background in finance. Neither does Phil. Phil has a slight background in ag. I grew up south of Boston. But we decided to buy a domain. We said, all right, we're calling it the Perennial Fund, bought the perennialfund.com. And the next day started emailing investors, started emailing farmers, started to build momentum. We didn't know a single investor back then, like zero. Rolodex didn't exist. So we were having to figure it out on the fly. And fortunately, because what we were doing was so needed for farmers and ranchers and didn't exist to investors, private credit for individuals wanting to invest in the food space. We were able to go so narrow that we were able to carve out an opportunity for ourselves to be able to gain some traction despite our lack of experience and the very large assumptions that were still outstanding. So by 2021, we were able to gather a small group of about 42 investors. We raised a $10 million Fund 1. From there, we used that to build momentum and raise a couple of managed accounts. And then most recently, as of last week, September of 2025, we were able to close our second fund. It resonated a little more than we had actually anticipated. So we ended up raising, the initial target was $50 million. We ended up seeing such positive receptivity that we raised the cap to $80 million and ended up closing just shy of that. Closed about $78 million into Fund 2. And all this capital is going to be directed directly into the hands of farmers transitioning to organic and ranchers to regenerative. We've already deployed about a third of the fund and on track to fully deploy the fund by the end of 2026. And with the way these businesses go, we're already starting to raise Fund 3. So it's, on to the next one and continuing to build the momentum in the space. I'd say since COVID, since 2020, and since people realized that, food doesn't just show up on the Whole Foods shelf, it actually has to grow on a farm. I've seen the momentum and the kind of cultural significance of recognizing the quality and origin of people's products gain a lot more prominence in their kind of daily awareness.
Yep.
And we think it's the right time and it's the right wave to be riding. So we're feeling really fortunate that there's just kind of this coalescing of different factors around our own growth, personal journey, business journey, but also, macro valuations are high. Investors are looking to de-risk. They're looking for uncorrelated exposure to, things like fixed income. And then at the same time, there's a cultural awareness around the health crisis that we're facing in the US and globally. And we're right in the middle, right there at the right time, the right place. So we're feeling really grateful. And I appreciate that it's come together in this way.
And the initial geographic focus has been Midwest farmers. Is that going to continue to be the focus for Fund 2 and beyond, or how do you think about that?
Yeah, so we started with Midwest row crop producers because the data is most abundant there from an underwriting perspective. So being able to see where a producer sits and related to county averages, to be able to access market data more readily and to have more predictability. Row crop producers these are simpler operations in many ways than like a intensive vegetable operation that's growing 15 different crops. So because of that, we started in the heart of the Midwest. Additionally, it's also where all the extraction is occurring in the food system in the United States. It's where the largest amount of herbicides, various insecticides, just the biocides are being applied.
Yep.
It's where, the Mississippi Delta is where the pollution is coming from. It's where our soil is running off.
Yep.
And it's also some of the most productive farmland in the world. So it's kind of just like zone zero, like let's start here and let's dial in and figure this out. And then from there, expand our scope into different customer types, different financial product types. So that's where we started. That's where right now 70% of our portfolio is located, and that's 70% of the type of farm that we finance, organic row crops in the Midwest. But recently, we've started doing much more work in the holistic management in large grazing systems. These tend to be in the Mountain West or the West. So we have a large ranch that we're partnered with in Texas, a couple in Colorado, a couple in Montana, as well as California. And we're starting to rebalance the portfolio And we'll probably end up closer to 50-50 to potentially even having exposure to slightly more ranching than we do row crop. There's a couple of reasons for that, but one is ranching impacts much more land, just much more acreage. You know, the biggest ranch in our portfolio is now over 50,000 acres. It's huge, and you know that's roughly a $4 to $5 million allocation, but we can impact many tens of thousands of acres. Row crop operations are much more capital intensive. It just takes many more dollars per acre to operate them. So we need both to really create fundamental change. But that's how we're currently expanding in the new customer type we're growing into. Yeah.
So much good stuff there. Putting on the investor hat and looking at the value proposition. So my own personal story, I helped steward a philanthropic foundation. We had some liquidity came in, and it was sitting in cash and bond instruments. And we're like, we want to put this towards impact. And I called up my friend, Alexa Firminish. She gave me a list of some of her favorites. You were on the list, and we started to kind of make some calls and say, okay, who is doing interesting stuff? And, you know, what we encountered at the very high level was like, okay, we can help support farms transitioning, and you're offering a straightforward yield-bearing instrument here, and it's collateralized by real assets. Like, so this is the, you know, when you hear lending, you might think, well, how do we know that the farmer is going to pay you back? But like, you have a pretty robust set of confidence that the farmer has an aligned incentive. And so I'd love for you to talk a bit about that, and then maybe get into a bit more of the mechanics of the dual structure with the preferred and the impact, and how you've kind of catalyzed this and your partners who have helped catalyze this vehicle.
Yeah, so sometimes there's a perspective that debt can be extractive, but debt can also be very additive and can be the exact right instrument for a producer. If we have confidence around their historical cash flows and their ability to take an acre from conventional to certified organic, and we can see the economics conventionally, transitionally, organically, and then maybe they're doing that on 1,000 acres. And they have a lease that comes up next door for another 1,000 acres. They come to us, they say, hey, I've already been doing this for a decade and I've got all the data. I want to go do this again. They already have the blueprint, they have the template. Now they need to replicate it, but their barrier is just capital. They need more money to sign the lease, to have working capital, to invest in that transition. That's where we can get a very high degree of confidence around their ability to achieve the output that we both want. And they can do it in a way where they don't need to go and sell half their business. They can use debt and they can borrow against the underlying assets, whether that be their farmland, their crop, insurance, equipment. They can back it with a mixed pool of assets and then use debt, which is fairly inexpensive compared to selling equity. You know, we're a market rate lender, so we're charging about 8.5% plus or minus about 0.5%, depending on the risk. And if that farmer can borrow, you know, $1 and have to pay 8 cents to borrow that $1, but then they can generate an ROI of an additional 20 or 30 cents, it's a pretty good return on their investment. But debt works both ways, because if they underperform and then they can't service the debt, that's where they're going to have to look to potentially liquidate assets to be able to make the debt payment. Fortunately, we have a more patient long-term view. We really get to know our operators. And if they have 1 year where yield is off because it didn't rain, or maybe it rained too much, or prices were suppressed, we have the flexibility to help them move into the next season and to give them a few shots. If they're, you know, willing and able, and they're coming to the table and they're a true partner, we're willing to roll up our sleeves and kind of get in deep with them and figure out how to navigate the transition, because it can be hard. And we've had a couple of those where things didn't go exactly according to plan. But as long as they're a great operator and they're going to be able to see it through, that's where we can saddle up with them and help them get to the other side.
Right. Because you could be a predatory lender. I mean, there's different, nuance here about how you act as a lender. And so, you've kind of designed in your fund structure how to be patient and how to be on the side of the farmer. What are some of those additional mechanics?
Yeah, so in Fund 2, we have two classes of equity. So it's called the blended finance vehicle. So we've been able to mix together the incentives and goals of both more financially oriented but impact investors and more philanthropic investors. And the way that we welded those two together was by these two classes of equity. So we have a tranche called the impact tranche that's in junior position, and they're taking half the return of the preferred investors. And then we have a preferred stack. These folks are in senior position, and they're getting paid about double the return of the impact investors. The reason that that's important is because the impact investors don't see any capital returned until the preferred investors have been made whole. So this is a first loss layer. It's a really protectionary layer. If something were to go wrong in the fund, those philanthropic investors like the Rockefeller Foundation and Builders Vision and the Schmidt Family Foundation stepped up and acted as a catalyst to ultimately then incentivize more risk-averse institutional or maybe investors who just they don't have a substantial amount of capital. They might be an individual with 5 or 10 million in assets, and they aren't comfortable with a second-time fund manager in a space that they've never invested into before. So because of that, we're able to create the right incentives for about, in Fund 2, about $20 million of the 78 is in that impact class. And then the other balance, the 48 million, is in the preferred tranche. So about $1 to $3 is in that impact class, creating the risk return profile that makes these preferred investors very comfortable being able to come into a second time fund. Ultimately, we hope to be able to scale without using those types of philanthropic dollars, but right now, as we're proving out the risk return profile, the portfolio performance, our ability to source deals, to underwrite transactions and service them all the way to maturity, it's a really ideal container in order to use philanthropic capital for what I think is its highest and best use, which is creating scalable mechanisms that ultimately create durable, free market-based structures that can then exist in perpetuity. And we are in the midst of doing that. And because of some of our partners that came in that impact class, we've now reached 100 million in assets as a firm. And I think we're now on the threshold of being able to access much more institutional capital from the big wirehouses that are out there, the Goldmans, the Wells Fargos, the JP Morgans of the world. And we need to work with them. They are stewards of trillions of dollars because if we want to change the food system, it's not going to be mad capital with 100 million in assets. Sure, that is a lot of capital to any individual, but to the food system, we need billions, if not trillions, in order to make a true substantial difference here.
Yeah, I would emphasize the importance of that dual structure from my own lens. I don't think I've said this to you explicitly, but that's what got us over the line. I mean, we're just a tiny little modest check in your preferred stack, but for us, it was like everything was new. The relationship with Matt was new. Your fund was still just kind of getting started. Fund 2, our comfort and ability to just kind of get confidence behind the investment. The closure, I remember for us, was internally we were talking about it, and we're like, we're sitting on the stack above Rockefeller Foundation. They've already de-risked it for us. They've already taken this huge part of the risk, to ensure that we can get whatever 7%. Maybe it's a little bit lower than that if things don't go well. It's fine, and we're just chipping in and contributing to this initial catalytic step where, eye on the prize is the billions and trillions. You guys got to, kind of prove the model and get out there. But I think what they did and your other partners did, like Schmidt Family Foundation and so forth, like that to me, like you said, is such a pure contribution from the philanthropic space, because it's helping to catalyze these new scalable vehicles. So that was, for us, that was a real difference maker as well.
That's good to know. Yeah, and we hope that we don't tap into that first loss impact pool at all. I mean, we would love to hit our full return targets and maybe even outperform it. And the portfolio is on track to actually outperform it at this stage. We've been able to achieve a slightly higher interest rate than we had planned with, a zero loss ratio. But it does reduce the real risk and the perception of risk for a fund two manager, because there are some investors we talk with that they want us to come back in vintage 4, 5, or 6, and they're not even going to look at us until we're $1 billion in assets. So we're fortunate for your commitment and you also recognizing that the reduction in risk because of that impacts layer. Not every investor, I was actually surprised, not every investor tuned into that nuance. But if you actually played with the fund model, which you could crank up, charge-off rates to an absurd level, about 30% of the portfolio could go to zero and not collect any underlying collateral, and pref investors are still going to have a return on their initially invested capital. So we've used financial engineering in a way that's, I think, somewhat clever, but also speaks to the interest of every party that's involved. There's no, like funny manipulation that's going on here. We're actually just helping foundations do what they also want to do best.
Right. Because ultimately foundations, I mean, there's something like $1 trillion in foundation capital that's sitting on the balance sheet. And a lot of that is in traditional stock and bond portfolios. So in philanthropy, a lot of conversation is always on the grant making side, but the endowment side is really exciting pool of capital that we can potentially go to finance some of these large land use shifts and transitions. We've been looking at it more closely now from the forestry side as well. And I think a lot of these same unit economics and fundamentals in the lending markets have broad applicability across a lot of impact land transition. Now, of course, one of the trade-offs, again, from kind of an investor hat is illiquidity, right? So if I'm in a U.S. government bond, I could kind of get in and out very easily any given time. I hand my money over to Perennial Fund 2, like I'm not going to see that for a while. So talk me through the mechanics of how that works.
So at the moment, our Fund 1 is a 10-year closed-ended fund. We've started making distributions. We're over a 50% DPI now. So $10 million fund, we've returned over $5 million back to our investors. And there's still a large portfolio there that's slowly paying down as we're kind of in harvest mode and that portfolio winds down. Fund 2, we're in the phase where we are actively deploying. So we just closed the fund last week. We still have roughly 40-ish, 35, 40 million in dry powder to deploy into loans. And this is also a 10-year closed-ended vehicle. So after we deploy the fund, we'll then start seeing interest payments and principal payments, maturities, early prepays, and then we'll start making those distributions to investors. But like you said, it is illiquid. You wouldn't be able to call us up tomorrow and say, hey, I want the cash out. It's not designed to be able to do that because the capital has been loaned out to farmers on a certain time schedule. So we're thinking of solving that in Fund 3. The way we've been conceptualizing that to date, and this is all subject to change, is creating an open-ended evergreen fund. So a truly perennial vehicle that would exist in perpetuity, hypothetically forever, where investors can invest into different classes that have different lockup and redemption periods. So this would allow investors who are maybe more sensitive to different liquidity timeframes to come into the fund and then exit 3 or 4 years later, on a more regular cadence. And the exits would be cash flowed by the underlying portfolio construction, where we're going to have some guardrails around a certain percentage of the portfolio will have to be in 12-month or less loans. There'll be a tranche that are in 24, let's say 60-month loans, and then there'll be a base that might be 60-month and onward. And if we were to cap the redemption cycles at, say, 10% of net asset value of NAV on a yearly basis, as long as 10% of the portfolio is maturing on a yearly basis, the underlying construction can then support that liquidity. We're in the midst of designing that right now and trying to figure out what those right levers and redemption cycles and percent of NAV is right for us, because we don't want the tail to wag the dog here, where investors define the strategy. We need the strategy and what our producers need and what would best service them to inform what we bring to the market. That is a tension, obviously, where it has to meet the needs of investors as well. But we're in the midst of thinking through where we can compromise on both sides of those markets to make them work. And we have an early term sheet we've been working on just to help ground some of these ideas. And it's an exciting endeavor for us, because Fund 3 would be the last credit fund that we launch. And that would be the vehicle that we would ultimately raise to $1 billion, $2 billion, and onward, by continually leaving it open for subscriptions for investors to participate, and then matching that fundraising pace with our deployment pace. Because we think, and I believe that we have the ability to scale to a $1 to $2 billion manager in the particular niche that we're focused in the United States. But that is a belief. That's an assumption. It's unproven. We've kind of taken it from 0 to 1, from 0 to 100 million in assets, and now to go from 100 million to $1 billion. It's a different type of building. It's a different type of phase, going from maybe more of a creative kind of function and putting the vehicle together, to now really focusing on replication and more internal operations, optimization, thinking about how to take it from building the factory to actually running the factory. So the whole team of 5, or a small team, but we're thinking about that transition phase, because we are at kind of that threshold moment, and we're excited for what's to come with Fund 3, and hopefully I'll be sharing more about that starting in 2026.
And does $1 billion get you to the 10 million acres? What takes you to 10 million acres? Yeah.
So 10 million acres is the goal of MAD as a collective. Our portion that we've been assigned to be responsible for is 5 million. So $1 billion does get us to that 5 million acres mark. Yeah. But cool. I want to see how far we can push it.
Of course.
Hopefully we go further.
I think there's terrific, tailwinds here, and the grit and determination of getting those first funds. You said you and Phil don't have, a finance background to start, and yet here you are as regenerative financial engineers, if you will. Any reflections, surprises, observations now that you've been having a lot of fundraising conversations, talking to a lot of institutions, family offices, foundations, and so forth?
Yeah, I would say finance is not that complicated. It's pretty simple. At the end of the day, we make a loan to a farmer on the concept that they will use that capital to then create a return on those dollars. They'll be able to take $1, turn it into $1.10 by somehow producing more yield, selling into a new market, et cetera. Same concept, whether you're investing in private equity or venture, whatever it may be. You're investing in the growth proposition of value being added over time, which, many natural-based systems are also additive over time. If you're seeing a forest fire just swept through and you have a barren landscape, and then suddenly you have, seedlings that are germinating and then collecting sunlight, you're going to see an accretion of energy over time. And that energy is very similar to how financial value can also accrete. I mean, money is just like an abstraction in many ways of real value. And I think because Phil and I didn't come from a finance background, we took a more simple kind of fundamental approach to this and just recognized that if you can help farmer or rancher do well, do better than they were before, that they'll create value. And if we can keep a small piece of that by being a partner and helping them get there, we can create a durable business. So I think unfortunately, the finance world has convinced people that it's more complicated than it is, because advisors and all the other folks that are out there want to somehow extract
That's how we get
value
our fees.
from people.
Yeah.
That's how you get your fees. Exactly. But a lot of these people don't necessarily deserve fees, and they create these complex like CDOs and CLOs and derivatives of derivatives and options, and it's all just financialization for the sake of financialization to try to somehow make some money off of someone else's money. And I wish that the financial industry wasn't inflating to the degree that it has. I don't have the exact data in front of me, but I believe it was in 1900, only 1% to 2% of GDP was dedicated to financial services. And now I believe it's up to 6 to 8%. So it's like quadrupled. But what are we doing differently than we were doing in 1900, right? We're still lending, we're still investing, but because there's more wealth that's been created, like literal prosperity in life, whether it's access to air conditioning or food or transportation, whatever it may be, the standard of living is much better than it was. There's more to go around. And that means that there are more people ready to be somewhat parasitic on the wealth that others have generated. So I think Phil and I's approach towards just wanting to help people do better and do it in a really simple fashion helped us think outside the box and not overcomplicate it. I think a lot in life is simpler than people give credit to. People tend to overcomplicate things.
Well said. If there are any farmers or funders or folks that want to start a conversation with you, how do they get in touch and where do they go?
You can email me, brandon@madcapital.com, or visit our website. So most of our farmers are getting in touch by either giving us a call or shooting us a text, 1-844-FARM-MAD. So we got that dialed in.
Cool.
Or they're reaching out via our online form on the website. And then many investors are getting a referral or somehow getting an introduction through someone that they know that's invested. We've got over 140 LPs now. So we're starting to also hit this great network effect. That was something that was important to me, was to actually have a low minimum in our funds. So in Fund 2, our minimum was $50,000. And that's high for a normal individual, but it's more accessible than many funds that set a $500,000 or $1 million minimum. Yeah. And I often find that the people that are investing 50 or 100,000 are the most mission aligned, and they care, and they're more energetic, and they're more helpful than some of our larger investors. So we definitely want to invite as many people as we can into the movement. And there might be ways where we can continue to lower that into the future as we think about growing.
Yeah, excellent. Any questions I didn't ask, or any other key points you want to raise?
I think as long as capital is stewarded in a way that's conscientious across all parties and everyone's satisfied and agreeing to the terms and nobody's being taken advantage of, that's where finance can be, additive and regenerative and help take both parties to a place where they want to be participating in the food system. So I think that all the new tools that are coming online, whether it's MRV and carbon, or maybe some of your Web3 work or other blockchain work, all of this is great kind of plumbing, and it's all part of the kind of stack that we're building to help change the food system. But we have more tools that are currently available than I think people give credit to. I mean, money's an abstraction and how we move and account for it can be done in as simple as an Excel sheet, right? And we're living proof, of that. And we've been able to help farmers now transition over 30,000 acres of farmland from conventional to organic. And we're going to double that and triple it and keep going in the coming years. So I think we need more people. We just need a larger kind of tribe here that is really trying to drive regenerative finance forward and do it in a way that's very simple. I think, I need to be able, one of my litmus tests is like, can I sit down and explain this to my parents and will they understand it? And they do right now. So as long as if I can keep that on track, I think that's a good test.
Excellent. Yeah. Brandon Welch, thank you so much.
Thank you. Appreciate it.
We will put links in the show notes, and for more conversations, just go to maearth.com. Thanks for tuning in. We'll see you next time.